All right, let's get right into it. The New York Stock Exchange, right? An institution that's been the center of finance for over 200 years, is cooking up something that sounds like it's straight out of science fiction. They're planning to make the stock market run 24/7, all powered by blockchain technology, basically turning a share of stock into a secure digital token. And look, this isn't just about adding a few more trading hours. This is a fundamental rewiring of how Wall Street works, moving everything onto a shared, unchangeable digital ledger. It's a huge deal.
So what's the big idea? What's the dream they're selling us? Well, on the left, you've got the world we know, a market that opens and closes, trades that actually take a day or more to officially settle, and let's be honest, pretty high barriers to entry. But on the right, that's the promise, a market that never ever sleeps, trades that happen in the blink of an eye, and the ability for anyone, anywhere to buy just a tiny slice of a share for a few bucks. It's this grand vision of a totally democratized global financial system.
You have to ask, though, why is the NYSE doing this? What problems are they actually trying to solve with such a massive, complicated project? Well, it turns out they're going after some of the oldest, most frustrating problems in finance.
First off, time zones. If you live outside the US, the market is open at some seriously weird hours. A 24/7 market completely erases that problem. Then there's settlement risk. Right now, when you buy a stock, the whole thing doesn't officially settle for a day. A lot can go wrong in 24 hours. Instant settlement? Problem solved. It also helps new investors get in the game by offering fractional shares. And maybe the biggest one for traders is getting rid of gap risk. You know, when a company drops bad news overnight and the stock price just falls off a cliff the second the market opens before you can do anything about it, in this new world, you could react instantly.
This quote really nails the ultimate goal, doesn't it? A single, seamless network where money just flows instantly around the world. A bigger earnings report out of Tokyo, a political shock in Europe, you could trade on that news the second it breaks. It would create a market that actually reflects our 24/7 world in real time. But what happens when the lights never, ever go out?
And that brings us to our first huge problem. This beautiful vision of a busy, bustling market at all hours of the night, it might just be a mirage. Because you have to ask the simple question, who is actually trading at 3 a.m. and where is all that money going to come from?
The data here tells a pretty stark story. About 85% of all stock trading happens during that tight 9:30 to 4 o'clock window. And there's a good reason for that. That's when companies release their news, it's when all the professional traders are at their desks, and it's when global business is really humming. Spreading that same amount of activity over 24 hours doesn't magically create more trading, it just spreads it dangerously thin.
And this is where things get expensive for you, the investor. We need to talk about something called the bid-ask spread. The simplest way to think about it is that it's the hidden fee you pay on every single trade. A tiny spread means the market is healthy, lots of people are trading, and your trades are cheap. A wide spread means the exact opposite. Well, during those quiet, low-volume overnight hours, that spread can absolutely explode. We're talking 3 to 5 times wider than it is during the day. So here's the bottom line. Yeah, you can trade at 3 a.m., but it's going to cost you a whole lot more to do it. The doors are open, but it's an expensive and inefficient place to be.
This thin, fragile market creates the perfect storm for something called dark night raids. With so few buyers and sellers around, even a relatively small trade can cause a massive, totally artificial swing in a stock's price. It's an environment that is just begging to be manipulated, a lesson we have learned the hard way over and over again in the 24/7 crypto market.
Okay, so beyond all the market mechanics and the numbers, there's another cost we have to talk about, a more personal one. What is a market that never sleeps do to the actual human beings who are supposed to participate in it?
This question really gets to the heart of the matter. The technology makes a 24/7 market possible, sure, but our human biology, we haven't exactly evolved to keep up. This new market is perfectly designed for high-frequency trading algorithms that don't eat, don't sleep, and don't feel. But for people, that is a very different story.
You know, all the research coming out of the crypto world paints a really worrying picture. A market that is constantly moving creates this toxic cocktail of decision fatigue, compulsive screen checking, and a massive fear of missing out, or FOMO. Studies are already showing this leads to sleep deprivation and serious anxiety, with people tying their entire self-worth to the minute-by-minute ticks of their portfolio. It just encourages overtrading, which, as we know, is the fastest way to lose money.
And here's the real irony. This whole thing is being sold as a win for democracy and the little guy, but it might actually create an even bigger gap. The average person is now trapped, trading in the middle of the night with higher costs and way less information.
Meanwhile, the big institutions, they have global, round-the-clock teams and super sophisticated algorithms. It gives them an edge that is almost impossible to overcome.
So if all that wasn't enough to worry about, we come to what might be the biggest hurdle of them all. How in the world do you police a market that has no borders and no closing time?
Just think about this scenario for a second. You have a trader in Seoul, a broker in Singapore, and they're trading on a U.S. exchange. Something goes wrong at 2 a.m. Who's in charge? Whose laws apply? Who do you even call? This is the legal black hole sitting right at the center of 24/7 global trading. Our entire legal system is built around national borders. This market simply isn't.
For regulators like the SEC, this is an absolute nightmare. First, you've got the risk of regulatory arbitrage. That's a fancy way of saying bad actors will just set up shop in countries with the weakest laws. Then there's the massive challenge of just monitoring this unbelievable, non-stop fire hose of data. And most importantly, how do you make sure an investor in Asia gets the exact same legal protections as someone in America? It's a huge, huge problem.
This chart kind of lays out how everyone is pulling in a different direction. The exchanges, like the NYSE, they want more trading volume because that means more fees for them. The market makers who provide liquidity face higher costs and new risks. Retail investors, well, they get more access, but they also face a ton of new dangers. And the poor regulators are stuck right in the middle, trying to encourage innovation while preventing the entire system from blowing up.
So after weighing this incredible promise against some really serious dangers, you have to ask the big question. Is this a revolution that we're actually prepared for?
You see, the technology to build all this, it's pretty much already here. In a way, that's the easy part. The real hurdles, the giant mountains to climb, are first, getting regulatory approval for a system this radically new, and second, and this is the hardest of all, is adapting our existing market structures and our own human behaviors to a world that literally has no off switch.
For the average investor, it all boils down to this fundamental trade-off. You get unprecedented access to the market anytime, anywhere. But as we've seen, that access could come with much higher costs, intense psychological pressure, and a playing field that's tilted even further against you. Is that a price you're willing to pay?
And for the market itself, the dilemma is just as stark. Sure, instant settlement is technically more efficient. But does a market that never has a natural pause, that never gets a chance to cool down, catch its breath, and reflect, does it become dangerously fragile? Is it more likely to have the kinds of flash crashes and wild swings that we've been talking about?
So in the end, it all comes down to this. The code is just about written, the servers are ready to be switched on, the technology is no longer the barrier. The real question, the one we all have to answer, is whether our laws, our institutions, and frankly, our own human psychology are ready for what comes next. Are we?